Afternoon, class. I'm going to spend just a few minutes, and it's going to be a short video. Spend just a few minutes going over some information that you're going to find helpful to review before you take quiz number 2 in this class. Just remember, when we're talking about law of demand, essentially what law of demand says is lower prices means more quantity demanded. Price on the vertical, quantity on the horizontal, downward sloping demand curve. So as you're moving along that demand curve, the lower the price, the more quantity demanded. Conversely, higher the price, less quantity demanded. Again, quantity demanded, we're moving along that demand curve. And that's different than a shift in the demand curve. You're going to have, demand shifters that are going to take and change and shift that demand curve either out, I guess you could say out to the right or down to the left. That's a shift in quantity. That's a shift in the demand curve. However, a shift in quantity demanded is just movement along that curve. And when we're talking about quantity demanded in the demand curve, everything is fixed at that point, except price and quantity as you're moving along that demand curve. We talk about economists are notorious, or maybe people have used a few other choice words for us, but we're notorious for ceteris paribus. We're trying to simplify the world, as we talked about in economic models. And what does ceteris paribus means? All other things equal, all other things unchanged. And basically, when we're talking about the demand curve, especially quantity demanded, everything is unchanged except, again, prices and quantities. Let's see what else I've got here. Oh, in the text, they talk about, they have an example talking about stock market. And basically, the stock market, it's the price of a stock is based on future expectations, future value, future profit, future dividends, future capital returns on an investment. So the stock price today, and I haven't looked, but Microsoft, the last time I looked was like $401 or $402. I don't remember the exact price for it, but the price for Microsoft on Friday is the investor's view of what the future value of that's going to be. And so, when you're talking about at lower prices, most people think that the future value of that stock is going to be, or the firm's earnings justifies that stock price. At higher prices, are just the opposite. Investors are looking at it and they don't think that the firm's future earnings, or at least the expectations of future earnings, are going to justify the higher price, so they're selling. Lower prices, again, law of demand. Lower prices, you're buying. Higher prices, most people are trying to sell. We talked about equilibrium price, and you hear some people talk about, well, equilibrium price is the right price. Well, equilibrium price is that price at which the market clears. Quantity demanded is equal to quantity supplied. Clears the market. That's the price that clears the market. Remember Adam Smith and his theory of the invisible hand is one of the parts, or one of the significant outcomes of that Wealth of Nations was Adam Smith says there's market forces out there that are going to drive supply and demand, going to drive it to equilibrium price. And he even talks about an invisible hand of the market forces driving it to the equilibrium price. And then the text talks quite a bit about price controls. And I think it's important, especially in this economy. And we are right now living in an economy that is stressing everybody out. That's a lot of it's driven by microeconomic factors like inflation and interest rates and things like that. But if you look at the theory of the firm, you look at individuals, it's stressing a lot of us because our disposable income is just not buying that same bundle of goods that it bought, say, 3 or 4 years ago. And the government, and again, government works off of normative. They have normative judgments, while economists have positive judgments. Positive judgments are, or analysts or economists, however you want to look at it, are based on how things really are. Normative judgments are based on how things should be. And government officials think they know better than anybody else about how things should be. And that's, they actually, when it comes to price controls, whether it's, price floor or price ceiling, they're trying to establish a level at which it is a more equitable result for the economy or the population as a whole, but it's all based on normative judgments. One of the things that, in their ability to implement price controls, or their desire to implement price controls, it doesn't always, end in an equitable outcome. And also there, a lot of issues spring up where price controls end up with black markets. People are, buying and selling under the table, and there's the underground economy, and price controls can end up at the end of the day being just a mess for everybody. And again, it's the government making decisions based on normative information and based on normative judgments. And again, they are trying to set things up based on how they think everything should be, or how they think everything should work. And basically, they try to set these price controls in place when the market price is some way unfair or inequitable to a certain segment, let's say, of the population. And remember, you've got a price ceiling, which is the maximum legal price you can charge. Not talking about a black market price, we're talking about the maximum legal price you can charge. And most people, when they think of that, it's rent controls. In Europe, there's could be price controls on gas, could be on food, could be on healthcare. A lot of different price controls. Have some of those here in the United States, but a lot of them in Europe. But the one everybody mostly thinks about when they're talking about price controls, especially a price ceiling, is they're talking about rent control. So certain cities, that's the most a landlord can charge to rent a particular, unit within a housing project, or a unit to a consumer. Then you've got price floor, and that's the minimum legal price. And most people, you've got price floors on agricultural commodities, but then there's a lot of price floors here in the United States. Most people automatically think of what? They think of the minimum wage. And look what the minimum wage is doing in the state of California. Of course, I've lived in probably the 2 most messed up states to live in as far as government intervention and tax and government trying to run the show. And because I've lived in California and the state of New York. And, from my perspective, don't ever live in either one of those states unless you want to be controlled by the government constantly and be taxed to death. Tax burden in those 2 states are, they are terrible. And one of the things that you think about, especially on that minimum legal wage and the minimum wage rate, it's look at the impact that in the state of California it's having on fast food. Impact on a lot of things in the state of California, but especially on fast food, where they've implemented this a significant minimum wage for individuals working in the fast food industry. And I think that's all the notes I've got. But if you study your notes and pay attention to the videos, and I think you'll do reasonably well when it comes to taking quiz number 2. Thanks for joining.